All right, stocks are pissed again today. In just a moment, I'm going to talk about the Federal Reserve and an important warning that somebody from the Federal Reserve gives us. We'll break that down in just a moment. I do want to give you a heads up. This morning's PPI numbers were fantastic. The problem was the ones from last month were revised up, and the components that feed into the Fed's preferred inflation gauge weren't as ideal. That might be contributing to some of the selling today, though I actually think some of the selling today, yes, it could be because of these 200% tariffs on wine and alcohol with the EU and the ramping up of the EU trade war. I think some of it could be due to what JP Morgan told us 2 days ago, which was institutions might consider fading rallies. This is basically a way of saying that institutions might be of the impression that the next 6 months to maybe even a year or 2 years or longer could be less ideal for stock market returns, and there might be better opportunities in the private space, in treasury bonds, or just in opportunities. See, you have to also give a value to opportunity. Let's say you have cash because you got on a margin and you raised a little bit of cash on green days. It gives you that opportunity for when and if there's an oopsie-doopsies in the economy, maybe you can make an acquisition at a cheaper price. And that optionality creates value. Maybe more so than we can get just on sort of the daily buying the dip. And I'm not saying don't buy the dip. I'm simply arguing I think this is what institutions are doing. And some of that sell-off that we saw this morning, I think is driven by that. But for now, let's talk about some facts and data. Unemployment claims came in a little bit better than expected this morning, but there's a little bit of a risk factor here in that we're still above 20% of states signaling, quote, significantly rising unemployment claims. And usually what you see sort of the suits on Wall Street say is when you get over 20% of states with increasing unemployment claims, you could slowly be leaning towards a recession while masking the risk with the overall number seeming like it's stable, actually coming in 5K lower than expectations this morning, and seeming stable, but then that underlying state-by-state data creating potential risks. Now, in fairness though, we've seen those risks for over the last about 18 months of sort of those elevated underlying states with higher levels of unemployment. So maybe that's not as great of an immediate metric, but then again, unemployment claims usually aren't a great leading indicator of recession. It's usually after a recession, like when the recession is over, that they tend to peak out. So using it as a leading indicator is messy at best, and at worst is just plain downright wrong. And that's why instead, I'd like to just focus on what the Federal Reserve is warning us about, because we've got the Fed meeting next week that we got to pay attention to. So let's get into it. Hey, so I just read an opinion piece from Bill Dudley of the Federal Reserve. I think it's worth going through and understanding where his POV is on the Federal Reserve bailing out the Trump tariff stock market, if you will. So let's get into his details quickly. All right, so first thing, Bill Dudley, he is the former president of the Federal Reserve Bank of New York. He actually thinks that the Federal Reserve is going to end up being too complacent to stop the damage of tariffs. Now, every time I say something negative about tariffs, there are people like, well, we should equalize with other countries, and, why didn't you complain about tariffs under the Biden administration? I'm not trying to be political. It just doesn't really matter. The point is, tariffs equal more deadweight loss of government intervention. It's that simple. There should be no tariffs at all. We should have free trade. All sides should have no tariffs. Do I think that us implementing tariffs to try to get the other side to get rid of them is a good idea? Not necessarily, because I kind of think you're fighting a fire with fuel. It's not fighting fire with fire. It's literally just worsening it. I think there are other diplomatic ways to handle it, but I understand the marketing POV because it's, if we tax somebody else, we can give tax breaks to Americans. Sure. And it's possible that we're actually going to pull off those tax breaks to Americans, because I think that Republicans are sort of holding on to the budget reconciliation measures, which they generally get 1 to 3 of per year, depending on how they divide, revenue spending and debt limit bills. And I think they want to use budget reconciliation to pass Trump tax cuts. So yeah, we expect Trump tax cuts to come as long as, we can actually get to that point. Right now, we got to get through preventing the government from getting shut down. Schumer, as we know, is trying to get an extension push to try to get individual spending bills considered. He only wants to extend the government budget for, somewhere around 29 days, sort of echoing more of a Thomas Massie Republican, like we shouldn't pass a budget extension for 7 months here. But if we don't pass a budget here by Friday, then the government will shut down and we'll have all that drama to deal with on top of the tariff drama. And that also kind of reiterates that the Federal Reserve probably won't step in to get involved with stopping the damage of a government shutdown either, though those tend to be overblown, the drama around those. What matters here is Bill Dudley suggests that the Federal Reserve themselves will be very worried to dare make the mistake again and call inflation transitory. See, a lot of people want to say, well, if we have some inflation shock again from tariffs, it'll just be sort of a one-time shock. In other words, it'll be transitory. But because the Federal Reserve has made that mistake in the past, they're unlikely to want to risk repeating that same nonsensical mistake, calling tariff inflation transitory. That, he believes, Bill Dudley that is, could end up leading the Fed to react too slowly. In addition, sticker shock from tariffs increasing supplier pricing, which could show up in some consumer pricing, might lead consumers to recoil. And then consumers don't buy it, and then retailers are forced to lower prices, and margins go down, and blah, 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 blah. This is all worsened by retaliation, which, we already talked this morning about how Canada had the very nominal energy tariffs, to which Donald Trump freaked out, and then Canada, quote unquote, folded and got rid of those energy tariffs, but today came up with probably 2x the tariffs that they had, that Trump implemented on them yesterday, with now over $20 billion of product exposed to 25% tariffs from Canada, steel, aluminum, iron, computers, and otherwise. All of these retaliatory tariffs are likely to be met with more retaliatory tariffs from Trump, which are then likely to be met with more retaliatory tariffs from countries like China, who is now allegedly wanting to buy more beef from Canada instead of the United States because, well, that's what happens in trade wars. In a trade war, the only thing you usually accomplish is anti-Americanism. And other countries just go, well, the enemy of my enemy is my friend, so you want to partner up? This is just normal. This is why I'm very anti-tariffs, but that's okay. I'll tell you when I give you my opinion and when I'm just kind of giving you data or facts. Generally, I just stick to facts here. And so Bill Dudley says markets are actually pricing in 3 cuts by mistake right now, because markets are assuming the Fed is going to view tariffs as transitory inflation. And therefore, they're pricing in 3 rate cuts, which is true. We were just talking about that yesterday. 3 rate cuts are priced in through January 2026. However, Bill Dudley says this is probably going to be wrong, partly because as we see a slowdown in markets right now and in business, Target, Walmart, some of the warnings that we're getting, airlines, the slowdown isn't dramatic enough to trigger real slack in the labor market. And with a lack of immigration and deportations, you're likely to see elevated wages, which elevated wages keeps service inflation high. In English, you're going to have a Fed that's not going to react quickly in the face of quote unquote transitory inflation from tariffs, because they're not going to believe that. So they'll lag on that. And they'll lag on responding to the labor market moving down slowly, because you might not see labor market stress until later. Obviously, if unemployment falls off a cliff, well, then we're probably in a deep doo-doo recession anyway, and the best time to buy the dip is when the Federal Reserve comes in, bails everything out, and fully U-turns, which I fully expect the Federal Reserve will U-turn in the future. Problem is we don't know when, and people like Bill Dudley are saying it's probably going to take a lot more time. He makes it clear, tariff inflation is still inflation. The Fed can't disregard it, especially if inflation expectations continue to rise, which if you look at the last U of M reports, inflation expectations are rising. It's not good. He also suggests that the Fed being reluctant to cut hurts bonds for now. So keep that in mind. It actually keeps yields higher for longer, which is also a problem because higher yields for longer create higher costs for businesses for longer and actually exacerbate the problem. So higher wages for longer, meaning higher service inflation likely. The tariff inflation won't be viewed as transitory. And potential pain for bonds still in the near term as the Fed is reluctant to cut means things are really going to have to go doo-doo for the Fed to cut. Now, if people think that next week Jay Powell on the Summary of Economic Projections is going to forecast 3 cuts, he says markets may be disappointed. and that you might want to be forewarned, not to expect 3 cuts from Powell, and instead expect the tight-lipped Powell going, everything's fine. Yeah, there's more uncertainty, but that hasn't materially affected the economy yet, and therefore, we're only penciling in 2 rate cuts. So that could be a risk. Along with, obviously, next week, we'll have this whole budget showdown again, and we'll see, are we actually going to be able to pass a budget next week, or by the end of this week, or not? You know, Democrats are freaking out about potentially entrenching benefits for Elon Musk with the White House, and they want amendments, and all this drama for a different video. So this is an update for you on what's going on with Bill Dudley and the warning that he provides, which I think is useful. Let me know what you think in the comments down below. As always, subscribe to the channel, and folks, we'll see you in the next one. All right, goodbye, and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.